Nilesh Shah of Kotak joins us now. He represents Kotak AMC. Nilesh, good morning. Thank you for joining us. We've seen a strong comeback in the market in last couple of weeks. Do you think this is as good as it gets? Do you think somewhere markets have done their bit on the upside for this calendar year and this financial year?
So markets today are obviously discounting the negative news. The GDP growth declined to 5% in June 19 quarter, and most analysts are expecting below 5% GDP growth in September 19 quarter. But market is discounting future. It is trying to build on growth recovery based on the corrective steps taken by the government and the RBI. Now, if those steps does result into desired results of growth recovery, then we could see market going forward. But if there is any disappointment on the growth recovery, then certainly these levels will find it difficult to hold.
Data points which have come out, the print on inflation yesterday, what the core data has come out, what SBI economist on Monday said about GDP plunging below 5%. Do you think hopes of a small and a mild recovery will be dismissed and challenged? Do you think we are staring at a larger, prolonged and longer slowdown purely based on the high frequency data which has got reported?
So if we look at inflation, we have a unique scenario where when headline inflation was low and core inflation was higher, we focused on core inflation or on the expectations that oil prices will go up and headline inflation will eventually go up. Today, when headline inflation is higher because of unseasonal rains impacting food and vegetable prices and core inflation has come down, we are focused on headline inflation. Somewhere we need to learn from US Fed, where the Dow Jones is at all-time high level, economic expansion is the longest in their history, unemployment rates are at bottom level, and yet they have already cut interest rate 3 times, and the market is taking them as insurance cut. In our case, we had insurance hike, in their case, they had insurance cuts. Now, clearly we need to come together from growth point of view. And the second quarter results which have come so far have shown interesting trends. One, in a overall gloomy scenario, companies in building material space have expanded margins. Pipes, fittings, tiles, they have grown rapidly. In a stagnant export market, tile companies over last 9 years has almost increased their export 10 times from a volume point of view. If we look at consumer durables numbers, they have come out quite bumper and in excess of 20% growth. The bank's NIMs have actually expanded in an environment where interest rates are supposed to come down. So there has been interesting twists and turns in the growth story. As long as we can bring our act together for pushing growth higher from the current low level, market will be optimistic about the future.
Nilesh, hi, morning. Just getting a little worried looking at the telecom stocks right now. The fact that DOT has now asked telecom companies to pay up the AGR dues within 3 months. And just looking at the kind of dues that they have, and these are not small, meager amounts. Bharti has dues worth about 62,188 crore rupees. Vodafone Idea dues stand at 54,184 crore rupees. And, one of our research analysts has just culled out data as to how much exposure banks have to Bharti alone. And that's a sizable sum. So just getting a little nervous here, wondering if any of these companies were to not pay up, if they were to go belly up, what's going to happen to these banks and the kind of ripple effect it'll have thereof?
So it's a very, very delicate situation where clearly companies which are reeling under the burden of competitive pressure are also being made accountable or being asked to pay for the earlier or previous dues. Now clearly this is a problem area where we require solution between industry, between regulator and the government, which can create a win-win situation. If the burden is shared partially by government, partially by consumers, and partially by the bankers, and partially by the telecom operators, then probably the burden can be shared and it won't create a ripple effect on the economy. Undoubtedly, we all need telecom connectivity. At the same time, we also have to ensure that the financial system does not get another shock on the NPA side. So it requires delicate solution making by combined efforts of regulator, government, bankers, and the telecom industry per se.
So, Nilesh, where is this problem headed? Do you think, in hindsight, if we buy telecom stocks, will it be remembered as brave investing or stupid investing?
Only time will tell whether that decision is right or wrong. But today, as portfolio managers, we have remained underweight telecom stocks. And this is primarily driven by our inability to understand developing scenario. Time has taught us that it's far better to invest in boring businesses than to invest in businesses where you are constantly walking on the minefields. I have my full sympathy to telecom companies, but as an investor, I need policy stability to build my projection.
I think there is an opportunity in the market. The so-called boring businesses which have a moat around them, whether it's consumer companies or some NBFCs or some banks, they are expensive. You know it better than anyone else that in investing, if you pay gold for buying silver, you will not make money. Your future returns would be projected. So good businesses, great businesses are not attractively priced. The problem is that what is attractive is not growing. It's like for an investor, you're stuck between rock and hard surface, value versus valuations.
It's a very, very valid question, Nikunj. What is looking safe is not cheap anymore, and what is looking cheap is not looking safe. But let me just point one hope which market probably is pricing in while buying into this quality stocks which are trading at super expensive valuations. Now, many of these companies are multinational companies, and legitimately they are paying pretty high royalty to their parents on the technology or services provided. Over a period of time, if those products can be Indianized and the royalty rates on the same could come down, then to a great extent these companies will have far higher profitability than what is priced in today. In some sense, one needs to evaluate this quality multinational companies not only as PE ratio, which is profit after tax, but also adding some of the royalty payments which could taper off over the years. If we make that adjustments, then to a great extent from super expensive valuations, they may come down to just around slightly expensive valuations.
Nilesh, I just want to touch upon aviation. Given the latest set of earnings from Spice again after Indigo, both of them citing industry growth tempering, citing costs as well, maintenance costs as well as individual reasons for higher costs in the past quarter. Does that concern you at all? What would be your outlook on aviation? Would you still be positive given the inherent demand scenario, or would you say the current commentary is a little troubling?
So by and large, I have grown up reading Warren Buffett, and his comment on aviation sector was that if people had shot down Wright brothers, so many fund managers would have extended their career. Clearly, globally, aviation sector has proven to be value destructive rather than earning return for the investors. Obviously, there are some shining examples, and we also had for a while in India shining examples. But by and large, aviation sector to us is a cyclical business rather than structural business. The policy uncertainty which comes due to aviation turbine fuel, due to other factors which are related to aviation sector, makes it very, very difficult to figure out how to project longer term cash flows or longer term profitability. Keeping that in mind, we have generally tried to buy aviation sector when it is very, very cheap and sell when it is cheap.
So Nilesh, since you quoted Warren Buffett, I think 3 years ago, Warren Buffett, Charlie, they both said that, look, we've not bought aviation stocks, but we bought aviation stocks, and investment right now in the aviation sector are so large that it is almost equivalent to buying a small airline company in America. So Buffett can change. I'm sure you can also change your view in aviation.
Undoubtedly, we have to be rigid in terms of our principle, but very flexible in terms of its applications. And which is where I mentioned that I will buy aviation stocks when they are very, very cheap and sell when they are cheap, rather than buying cheap and hoping that they will become expensive. Keeping in mind the policy uncertainty which is impacting aviation sector, I doubt if it's going to become a structural growth story. There will be undoubtedly growth, more airports are being added, more passengers are being added, but will that growth result into profitable growth for the investors in aviation sector? We need more evidences to prove that.
Nilesh, ultimately just boils down to what returns investors should expect. Whereas, intellectually both all of us can get into the nuances of the economy. For someone who is investing money via the SIP route, really wants to understand that if the starting point of a investment is November 2019, are those investments in for a double-digit return, single-digit return, or no return scenario for next 3 years? That is what the bottom line is, Nilesh. So let's address that. For someone who plans to start now, 3 years, what do you think should be the return?
So if you are looking at 3 years horizon to invest in equity, might as well not invest in equity. You can't be going in the cricket match saying that first ball I will hook, second ball I will square cut, third ball I will defend. You don't have that luxury. Who knows, the first ball could be Yorker, and if you are hooking, your wicket will be out. So please don't come to equity market with fixed time horizon. There will be volatility in market, and depending upon volatility, you'll have to adjust your stance. So please don't come with 3 year horizon, fixed term. Please come flexible. Maybe it will take 5 years, maybe it will take 18 months, maybe it will take 7 years, who knows. Equity market over a longer period of time, from a bear market to bear market or bull market to bull market, will give nominal return, which is linked to nominal GDP growth. Some funds may deliver little outperformance, some may deliver little underperformance, but broadly the indexes will track nominal GDP growth of the country. We are looking at nominal GDP to grow somewhere upwards in lower single digits. That's the kind of return you should expect. But please don't expect it on a fixed time horizon. Who knows what time it will take.
Argument given by everyone is that, look, inflation is low, nominal GDP is down, so don't expect good returns. Now that inflation is making a comeback, and we may be nearing the end of the rate cut cycle, do you think we should increase our return expectations then?
The spike in inflation because of food and vegetable prices can't be taken as a permanent increase in inflation. World over, people look at core inflation away from food and fuel prices. If I raise interest rates, it's not going to stop rains or bring rains. If I raise interest rates, it's not going to impact Saudi oil production, which will have influence on prices. It's not going to impact US sanctions on Iran, which will have impact on oil prices. So clearly we have to focus on core inflation rather than headline inflation. And core inflation today is about 3.5%. Your 10-year government security is 6.5%. That's 300 basis point real return for the government. Very rarely you see nominal interest rates of 3% in many countries. In India, we have real interest rate burden of 3%. There is a data published by RBI which talks about what is the average lending rate for the banking sector. The average lending rate for the banking sector minus the repo rate, which itself is at a premium to core inflation, is one of the highest in recent time. Now this is the burden which Indian entrepreneur is paying. And if we try to focus on headline inflation, which is influenced by food prices, vegetable prices, fuel prices, I think we'll go in a wrong direction.
Fair enough. Lots to continue to keep in mind. A lot of moving pieces right now, Nilesh, as we head towards the end of the year. We've been talking, of course, about certain themes from the banking and financial pack. I just want to get a sense of whether you're now looking further for opportunities, in the broader markets. Would you still be a little apprehensive, given that, like we discussed in telecom or other sectors, that we could possibly see some surprises in the near term with regards to some of the banks and their exposure to certain, to certain corporates? What would be your sense currently?
So within banking and financial services sector, there are 3-4 compartments. One is public sector banks. By and large, we have been underweight public sector banks. Of course, there are 1 or 2 exceptions, but by and large, we are underweight public sector banks. And our reasons for underweight is essentially one, compensation policy, where average pay of public sector employee is higher than average pay of a private sector bank. But at the top, public sector bank executives are paid pittance compared to private sector executives. Unless until this pyramid is corrected, public sector banks will not be able to attract talent as they used to attract in the past, and that could have serious implications for their business. The second thing is related to administrative flexibility for public sector banks. You get rotated every 3 years from one department to another. Now, this has its advantages, but it has also its disadvantages. One doesn't build specialization. In private sector bank, person in treasury will remain there for lifetime. In public sector bank, he'll move from treasury to rural department and vice versa. Unless until public sector banks are given compensation flexibility and administrative flexibility, I don't think so they will create value for shareholders. They'll have to manage many other conflicts. The second thing is corporate focused private sector banks. Again, here banks which have diversified their exposure, which are not exposed heavily to a particular sector or a particular company, we are generally overweight this particular sets of banks. The third thing is related to financial services like insurance companies, life as well as general mutual funds and so on and so forth. We think this is a growing area and selectively we are overweight in that sector. The fourth one is microfinance institutes. Again, microfinance has done reasonably well. We are overweight over that sector also. And finally comes NBFCs. This is a sector which is going through fair amount of turbulence. Over here, we are looking to invest in those NBFCs, and we are overweight those NBFCs where liability franchise is solid. They're able to raise resources from multiple sources, where governance issues are beyond doubt. There is fairly established standards of governance. And third, and the most important, where the asset quality is beyond questionable, calculations or accounting standards. So this is where we are looking to invest in banking and financial services. From a sectoral point of view, we might be just neutral weight. But there are pockets where we are selectively overweight, like private sector banks, corporate focused banks, microfinance institutes, good NBFCs, and financial services. And we are underweight certain pockets like public sector banks.
All right. Thank you so much for joining us this morning, Nilesh, and talking us through the current scenario and your view on things as they stand.